Welcome to our analysis of global macro signals as of February 15, 2026. We're examining a critical transition in the global economy. Markets are moving from a higher for longer interest rate regime toward what analysts call a fragile equilibrium. Key signals to watch: a 50% probability of a soft landing scenario, gold trading above $5,000 per ounce, and US-China tariffs that have escalated to 145 and 125%, respectively. We're witnessing a fundamental regime shift in global macroeconomics. Four structural changes now dominate the landscape. First, monetary policy divergence has replaced synchronized central bank actions. The Fed maintains restrictive policy, while the ECB signals patience. Second, deglobalization has become structural. Tariffs are now permanently embedded in trade architecture. Third, headline disinflation masks persistent services inflation that remains stubbornly above target. Fourth, AI-driven productivity growth coexists with legitimate bubble concerns in concentrated equity markets. This creates a fragile equilibrium, stable on the surface but vulnerable to shocks. Let's walk through the timeline that brought us here. In February 2025, initial Trump tariff announcements marked the beginning of dramatic escalation. Tariffs on Canada and Mexico started at 25%. China faced 10%. These eventually reached 145% by early 2026. Around the same time, the Federal Reserve signaled its higher-for-longer stance. It held rates at 4.25 to 4.50% earlier than markets anticipated. The Bank of Japan accelerated its normalization path. It raised rates to 0.50%, faster than many expected. By January 2026, gold breached $5,000 per ounce. It surged 14 to 16% year-to-date on safe haven demand. China experienced its weakest quarterly growth in 3 years at 4.5%. Property investment collapsed 17.2%. The Fed then implemented what markets interpreted as a hawkish pause. It held rates at 3.50 to 3.75% after 3 prior cuts. Meanwhile, Eurozone inflation fell below target to 1.7%. The ECB held rates steady. U.S. core CPI remained sticky despite headline inflation cooling to 2.4%. Looking ahead 12 months, 8 core themes define the landscape. Global growth appears resilient, but below trend. Consensus forecasts cluster around 2.6 to 3.3%. This avoids recession, but remains below pre-pandemic trends. Inflation shows a split personality. Headline measures continue disinflating, but core services inflation remains stubbornly sticky, between 2.5 and 3%. Tariff pass-through adds a structural floor of 3 to 5/10ths of a percentage point. Monetary policy has entered a divergence regime. The Fed is expected to deliver only 2 to 3 cuts through 2026. The Bank of Japan continues normalization toward 1%. The ECB remains flat through year-end. Trade architecture has fundamentally changed. Tariffs are now structural features rather than temporary measures. This slows global trade growth to approximately 2.2%. China faces a managed slowdown, with growth projected between 4.5 and 4.8%. The property sector drag persists without triggering systemic crisis. The AI boom presents a fascinating duality. It drives genuine productivity gains and capital expenditure, but bubble characteristics are increasingly visible. There's a 40 to 50% probability of meaningful correction by late 2026. Geopolitical risk premia remain persistently elevated. Oil markets carry a $5 to $10 per barrel premium. Foreign exchange markets experience frequent volatility spikes. Fixed income shows distinct time horizon dynamics. U.S. 10-year Treasury yields trade between 4.10 and 4.25% near term. They gradually decline toward 3.75 to 4.00% over 6 to 12 months. German bonds reflect the ECB's completed cutting cycle. They trade between 1.90 and 2.00% near term. Japanese government bonds face upward pressure. 10-year yields move from 0.90 to 1.00% toward 1.10 to 1.40% as Bank of Japan normalization accelerates. Credit markets show divergence. Investment grade spreads remain relatively stable. High yield faces widening pressure of 50 to 100 basis points. In equities, U.S. megacap AI stocks face high volatility with rising mean reversion risk. Value and cyclical sectors may benefit from rotation as valuations rebalance. Emerging markets excluding China present selective opportunities. Potential 5 to 8% upside exists over the medium term for countries benefiting from supply chain reconfiguration. Gold maintains its structural bull case. Projections point toward $5,500 per ounce. Central bank buying and persistent geopolitical concerns provide support. Oil trades in a volatile $60 to $75 per barrel range for Brent crude. This balances geopolitical risk premiums against weak demand growth. Foreign exchange markets reflect policy divergence. The U.S. dollar index trades between 105 and 108 near term. It moderates toward 100 to 103 over 12 months. The euro strengthens gradually against the dollar. The Japanese yen shows the most dramatic expected move, strengthening from 148 to 152 toward 135 to 142. Three interconnected causal chains explain how shocks propagate. First, the tariff inflation policy loop. Tariffs drive import price inflation. This keeps core services inflation sticky. The Fed holds rates higher for longer. Real yields rise, strengthening the dollar. This triggers emerging market capital outflows and risk-off dynamics. Second, the AI concentration risk channel. Massive AI capital expenditure drives equity valuation surges. This creates wealth effects supporting consumption, but a shock triggers equity derating and credit repricing. This tightens financial conditions broadly, creating GDP drag that forces central bank response. Third, the Japan normalization transmission mechanism. Bank of Japan rate hikes strengthen the yen. This unwinds the massive global carry trade, where investors borrowed cheap yen to purchase higher-yielding assets worldwide. Unwinding creates U.S. Treasury selling pressure and risk asset liquidation globally. This represents perhaps the largest structural shift in global liquidity since 2008. 5 critical risk scenarios define the probability distribution. The base case, fragile soft landing, carries a 50% probability. It features modest equity gains, dollar moderation, and treasury yields between 3.75 and 4.00%. An AI bubble burst carries 30% probability by late 2026. This could trigger 15% S&P 500 declines and 25% technology sector corrections. Full trade war escalation holds 15% probability. This could drive 20% equity declines and push gold above $6,000. A Japan shock unwind scenario holds 10% probability. Rapid Bank of Japan tightening could trigger massive carry trade unwinding, pushing U.S. Treasury yields 50 basis points higher. Additional risks include a China hard landing at 20% probability and geopolitical supply shocks at 25% probability. Critically, these scenarios can compound nonlinearly. An AI bust coinciding with trade war escalation could create recession risks far exceeding individual probabilities. 5 principles guide positioning in this fragile equilibrium. First, embrace divergence. Synchronized central bank policies are over. Cross-market relative value opportunities now dominate directional bets. Second, hedge the structural inflation floor created by tariffs and deglobalization. This persistent premium means central banks cannot return to ultra-low rate regimes. Third, position for AI volatility. Bubble characteristics are increasingly visible in concentrated equity markets. Fourth, prepare for the Japan liquidity event. Bank of Japan normalization represents the largest shift in global liquidity conditions since 2008. Fifth, exploit the fragile equilibrium itself. Markets are priced for a soft landing, but significantly underweight left-tail risks. These dynamics reveal 5 fundamental takeaways. The great moderation of low volatility is permanently over. Divergence dominates all asset allocation decisions. Geopolitics and tariffs are now permanently priced into market architecture. Convexity and tail protection remains systematically underpriced. and the Japan normalization process represents the most significant liquidity event facing global markets. Thank you for watching this analysis of global macro signals as of February 15, 2026. Remember to conduct your own research and consult qualified professionals before making any financial decisions. Stay informed, stay cautious, and navigate this fragile equilibrium with eyes wide open.